non-oil commodity markets. This could be the next big thing.
Where I think housing starts, construction, employment is going, there's a bias for more cuts.
Net zero was probably the dumbest thing any government's ever done, really. The CEO of NVIDIA, they're not going to replace hundreds of thousands of computer software engineers with AI.
Now I'm frustrated. I was hoping to replace Rich.
The dirty secret is that no one's ever going to get paid back. People have the shortest memories when it comes to investment. We just got to get Keith into Bitcoin.
Hey, there's a bubble.
What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Fitzgerald Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Fitzgerald's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a Loonie in any of these investments. Welcome back to Loonie Hour, episode 229. As always, joined by the three amigos, myself, Mr. Richard Diaz in Montreal, and Keith Dicker in IceCap Asset Management over in Halifax. Richard?
Hello.
What's going on?
Are we going to talk about it, or are we not going to talk about it?
Keep it brief.
I'm sad, but I thought we played well. Like, I'm not overly sad is what I want to say. You know, like I obviously we were the better team. Clearly, I was impressed how we dominated for almost 40 minutes. 3-on-3 is an abomination. I think we can all agree on that.
Thank you.
The US, I mean, we got goalied. I mean, the play by Devon Taves or whatever, I mean, that was just ridiculous. I still and my here's my hot take, and then I promise I'll shut up about it. And for another 4 years, I think that McDavid played hero ball in overtime. Sorry, I'm gonna say it. He tried to take three people on. Man. I didn't like it.
I would rewatch that play like 10 times, and I was like, man, I was like, who do I point the finger at? And I was like, the blame was kind of all around, but yeah, going 1-on-3 is that's a ballsy move.
It's a crapshoot. That's why 3-on-3 is stupid. But
okay,
anyway.
So my thing is, like, I posted that on Twitter. I think you did too.
Yeah.
And everyone's like, "Oh, stop making excuses." But I wasn't that I was making an excuse. I literally told my brother we were watching the game together. I was like, Canada outplayed them. They've got 40 plus shots. The game, it's a 1-1 game. It's like a super tight game. And now you're gonna open it up to this like 3-on-3 run and gun. It's basically like a 50-50 jump ball. It's like, you know, you miss the net wide and it goes around the other way for a breakaway, and I knew they were going to lose.
Yeah,
I had it in my gut. I was like 3-on-3. It's a shame. It's a shame to end it that way.
Yeah, I agree.
I watched it too. You know, it was, I watched every single game, of course. To give you some old guy, people may not want to hear this, but I'll say it anyway. I watched The Miracle on Ice in 1980. I remember I was down in my basement watching it. And, it was a lot of fun. But back then, the Americans played against the best team in the world. That team wore red shirts, and the country were all communists, well, most of them were. And the Americans won. They got significantly outplayed, and they ended up winning. So 40 years later, or whatever it is, it's,
So you're suggesting we are the red team full of commies?
Maybe, what do they call it? The Carney curse. Everything he's attended now, Canada has lost.
While we're on the things of controversy, Russia should be allowed to play. Okay, it's not a true Olympic hockey tournament without Russia. I think they are a legitimate contender for a gold medal. I don't know. Canada Russia's had so many good rivalries over the years, and I feel like that could have easily been like a Canada Russia final.
So I think we should keep sanctioning them. and let their hockey team play. I don't see why those.
Okay, yeah, we agree. We agree. There we go.
Yeah, but you should let all the athletes play. I mean, I'm
Yeah.
sure. I mean, just as there are a lot of Canadian athletes that may agree or disagree with the direction the country is taking. The same thing with the American athletes and so forth. Like, don't take it out on the athletes.
Not Ovechkin's fault, okay?
I mean,
Even though he
kids,
is friends
also
with
they're
Putin.
And the dude who wants to sit on his sofa and watch a hockey game. I mean,
Anyway,
we
okay.
go that way.
Anyways, what's going on? We got some interesting news on the housing front. We got a little bit more on the private credit. You know, it's one of the topics of conversation that's near and dear to Rich's heart. The net zero. There's a really good article this week in Bloomberg that we'll kind of touch on. But I thought it was one of the sort of things we've been talking about on the show is just the state. When Rich, I think we talked about it last week around like housing starts.
Yep.
And I was like,
And
hey,
how
like housing
I made
starts.
a big bobo on Twitter, and then you called me out.
Yeah, they're just such a lagging indicator, right? Which is
You guys had a Twitter fight?
Yeah, we did. I said something stupid, and then Steve basically
He called you on it.
Oh yeah, it was quite public, and then I went home and cried myself to sleep.
Like pre-sales are pre-sales are basically like the ingredient that goes into like what's called a housing start. And so again, I think most people forget that when you look at these housing start data, a housing start is once the foundation is built back to grade, right? And so like it's in a condo building, it's several years to get to what is called the housing start. And you know, step number one is you have to pre-sell, call it 60 to 70% of the building in order to get bank financing to even put a shovel in the ground, right? So like if you want to get an idea, the leading indicator of where like housing starts are going, you ultimately have to look at pre-sales. And we talked about it, which is in Toronto, for example, which is like the epicenter of this housing correction in Canada. Last year, for the entire year, was the weakest year on record for new home sales. It was just like a disaster. I mean, think about how much that population has grown, that city's grown, the GTA region has grown, and you had the fewest home sales on record dating back to the 1980s. So if you look at January, it's off to no better start. So this is data from Build GTA, which basically tracks all these pre-sale sales. There's 269 new homes sold in January. So for the entire GTA region, you had 269 new homes. It was the lowest, weakest January since 1981. So
Can I ask a dumb question?
Yeah, you're full of them these days. Go ahead.
My dumb question is that like homes, like condos and single family homes and row houses and attached? Or is
Yes.
it just condos or just single family homes?
The 269 new homes was like all product types.
Okay. Wow.
Okay. And then, so if you look, I think if you narrowed it down to just condos, it was like just over 80. So there's like 80 new condo sales. And so like, again, if you start extrapolating that over like a 12-month period, like you can see where this is going, which is like, there's basically no new housing sales. And again, of those, say 269 new homes, just because they're sold at the presentation center doesn't mean that project is going to move forward and build, right? Because like if you can only sell 20, 30% of your building, that's not enough to hit your bank financing requirements. So like chances are those sale contracts will be canceled, the deposit will be refunded to the buyer, and they'll never build. And so again, ultimately what this tells us is you're basically going to have like no new housing completions in the GTA region in, call it 2030.
4 years.
So
Steve,
it's going to be interesting. Like that's probably your next bull market, but I mean, obviously it's still what, 3, 4, 5 years away.
Steve, can I ask a stupid question?
Another one.
No, my question is just so I can know a bit more about it. So, but back with when you said when the foundation has to get up to grade, you mean like it basically has to get up above ground.
Yes.
And when it's physically above ground, that's when all of a sudden it'll hit the data points. As This
Yeah.
is a new housing start. Is that what you mean?
Yeah. Basically, you've built like you've dug the hole and then you've built the foundation back up, right? So you've built your footings effectively. That's when CMHC basically comes with their checkboard and says, "Yeah, okay, count it." So
So
yeah, they
the
actually
so the
send out-
NIMBY the NIMBY I have, because they're still below ground, that hasn't started yet officially until it comes up
Correct.
above
Yeah.
ground. So my next question is, in the GTA then, I guess, are there a lot of sort of new, can we all of a sudden see a sudden surge in housing starts? Because all of a sudden, projects that were started last year or 2 years ago, they're now starting to come above ground. And could that paint
No.
a positive picture that really isn't happening?
No, because I think if you look at like the health of the pre-sale space or the new construction space, like sales have been on an aggressive trajectory lower really since, call it, 2023, right? So like every year they've just been getting like weaker and weaker and weaker to the point now where you basically have like effectively, call it, zero sales. So in my opinion, like that housing starts data, while it is relatively volatile, it's I think it's on a very clear trajectory lower. Like I think if you look at the housing starts data, call it in 12 months from now, people are gonna go like, whoa, that's bad. So, and then in Vancouver's the same thing. Like it's not that far off from Toronto. Like the new housing market is effectively dead. Like it's basically.
So what are builders and buyers looking for then to say, the bottom is in, or I'm now going to get more aggressive? Like, do they have something they're looking for? Is it still doesn't feel right?
I think the development space, like honestly, like I'm not saying I'm standing here, empathizing and feeling bad for these guys because listen, there's been a lot of profits made over the last 20 years. But when I look at that space today, I'm like, I don't even know, like, I don't know when that space turns around. like some of these guys are just like, they're gonna have to move into different careers. Like the problem with
AI, you can do AI stuff.
Claude bot. The challenge is basically like the cost of new housing it's just expensive to build new housing. And there's various reasons, just the cost of the commodities that go into it. It's the government fees and taxes, which are still going up today, even in this down market. It's a lot of costs you can't necessarily control. Even if you throw in the land for free, like these projects, most of them don't pencil. So it's not necessarily that the land prices need to reset. I mean, in many cases, they've already fallen 50%. It's just the cost is so high. And the problem is the resale market now is gapping lower very quickly, right? Because like, if you think about it, if you're like, Keith, if you own a condo in Toronto and you've owned it for 15 years, you're like, listen, I've made $300,000-$400,000. Like, I want to sell and move on. Like, you take the bid, right? And like you reprice that market where you're willing to move on. Whereas like a developer can't just be like overnight, be like, oh, we'll take 20% less. Like there's your entire margins of the project. You've got limited partner investors, et cetera. You got the bank to sort of appease. So the developers they're not able to move with the market. They're not able to adjust quick enough. And so the gap between resale product and new product is just widening and widening, where there's such a huge premium now for new construction that like the numbers just don't make sense. And so the question is like, I think the only way you can get that market to pick back up is if that gap starts to narrow. And that means either the resale prices have to start going back up, or somehow, somewhere, developers have to find a whole ton of cost savings and massive, compression on their margins, which I just don't, I don't think there is. So yeah, I think that space is going to be in a lot of trouble for the next several years.
But I don't understand that, because like if you have like no demand, effectively is what you're telling me, then shouldn't prices for the new construction fall?
Well, they are falling, but there's only how much, like you have to look at your input cost to build new.
Right.
So you don't control commodity prices, the concrete, steel, copper
Right.
that goes into these buildings. You don't control interest rates, the cost that you're borrowing on. I mean, those are set in the market.
Right.
You can control your land price, but even if you throw in the land price today, these projects don't pencil. It's like give you the dirt for free. I mean, you're still not going to make any money in a lot of cases, not all cases. and then you have your government fees and taxes, which are call it 20-25% of the project. So like those aren't changing, and it actually they're arguably they're actually going higher. So it's like, well, where do you can trim your margins down from 15% to, I don't know, 5.
Okay. Crazy.
So like they're just not. Yeah.
Can I have another question then? Because like we've seen construction employment has actually held up really, really well. So like in the 90s, you saw construction employment fall 20%, 10-15%, from 1990 and bottomed in, let's say, 1993, 1994. The reason I sound confident is because I'm literally looking at the chart. And then in 2010 and 11, you sort of got the same thing, peaked in 2008 and then bottomed in 2009 and 10. We haven't seen that at all in Canada. You can argue that the peak was, just quickly looking, peak in construction employment was basically December 2024, but it's basically just been flat. So like, if no one's buying and no one's building, sorry,
I can square that peg. I think if you look at dwellings under construction, it's still really elevated. So like these projects, again, think about like a high rise. I mean, that's I don't know, 3-4 year construction period. Right. Like, so the projects are still being built. They've already started. Once you're on floor number 10, you ain't stopping. You gotta go to 30. So like these construction workers are employed because
money's been spent. Like the credit's already been.
Yeah, it's got to get finished now. And so what you're seeing obviously that you're also seeing like a lot of developers have pivoted to rental. I think the problem with rentals, as we saw now, like rents are declining nationally. That's a problem. I mean, it's great for renters, but it's not good for developers' pro formas. And so that's going to shut off that rental component pretty quick. I think it's already happening in many markets. Okay. And so, yeah, I think the fallout in the construction space is probably not today. It's probably 18 months from now we'll be talking about it.
Okay. Cool. Something to watch. Cheers.
We'll see. And on that front, yeah, like when I talked about the resale prices gapping down relatively quickly, right? They're adjusting. People like need to move on with their lives. You have estate sales, you have foreclosures, like that market can adjust quickly. So if you look at national house prices, they're now down 18% from the peak, which is the sharpest home price decline. Actually, sorry, house prices nationally are down they're 19.6%. So call it 20%. Okay. So that's the sharpest national house price correction that we have on record going back to the 80s.
But that's heavily weighted to Vancouver and Toronto. Places like Montreal, that has not been the case.
Yeah, I think if you look at like if you start to like parse it out, I mean,
or what about Red Deer?
You've got some of these suburban areas in Ontario that are down closer to almost 30%.
Yikes!
Right, and Ontario is a huge weighting of that national index. So yes, I would agree with you that the GTA is effectively bringing that down, but I think it's still interesting. I mean, it's still a data point that.
Hey, Steve, in Vancouver now, if someone is looking to sell their home, like when you have I don't mean you, but when other realtors are having the meeting with the family who's looking to sell, when you're trying to come up with a listing price, is it, well, if we list it here, you're probably going to get a bid way down here, or is it assumed right now? Because before you used to get people, bidding over ask, and I assume now it's just assumed that the bid will always be under ask. Is that what's happening in Vancouver and Toronto? I assume.
Yeah, the bid's always under ask. I think it's tough. It's interesting, right? It's like, residential real estate is so like emotional driven. It's so like people live in these. Think about these like. People have lived in this house for 15 years. They raised, a family there. Like there's emotions that are tied to this asset. And so telling someone that thinks their house is worth $2 million, that it's only worth 1.8 today. Like,
what are you saying? You don't like my house?
Yeah. You don't like my house. You don't like my renovations. You think do you think this is a shitty
I put in a bidet. Total bidet.
I did this like Home Depot.
You mean
like
reducing from 4 bedrooms to 2 wasn't a good move?
Yeah, it's a lot of this. So I think you just deal with those emotions, and it's always like that balancing act. Like you don't want to offend them, but at the same time, like if you're not blunt with people in this market, like you're doing them a disservice. Which is like they just sit on the market for 4 months, and then they're having to reduce their price 4 months from now. And the way the market is adjusting, I mean, right now you're seeing it as like home prices are dropping, call it 0.5% a month, 0.5%, close to 1%. So, if you annualize that out, I mean, takes you a year to sell. I mean, the market's moved another 8%.
Yikes.
Loonie hour math right there, everyone.
Something like that. Yeah.
So you're saying you don't
Anyways.
like my house? I'm sorry. I just stopped paying.
Okay, so we're still seeing the trend for real estate continues in the same direction.
Yeah, there's nothing that's changed. And just add to that, found this an interesting shout out to a good friend of the pod, Ben Rabideau, who's very helpful in sharing some of his data points here. Plug for Edge Analytics if you're in the real estate space. Sales to new listings ratio nationally fell to 45%, which is the weakest reading since the financial crisis. And before that, you'd have to go all the way back to 1995. So again, look at the sales to new listings ratio in Canada.
I have sorry, I know we're going on and on this topic, but I'm genuinely curious. Do you think like right now there's 0 rate cuts priced in? I mean, 0. There's just no the OIS market is basically flat. The credit cutting cycle is basically done from the Bank of Canada. Do you think if that changes materially, that it'll like reinvigorate animal spirits? Like I don't know, if we get worse economic data and the and Carolyn Rogers and her boy Tiff have to come and say, sorry, we were wrong, we're going to cut by another 50 basis points or whatever. Do you think that will change people's perspective, or do you think there's just
think people? I mean,
I know the answer. I know the answer to this one.
Keith and I might have a difference of opinions here, but I do think like people buy payments. Obviously,
people buy payments? What does that mean?
Well, like I don't think people buy houses. I think they buy payments, right? Which is like, hey, if your mortgage rate goes from 6% down to 4, down to 2, I mean, you're going to get more people entering the market because the payment on that house. I mean, I think National Bank put out a study that affordability is back to 2021 levels. So like it's come off quite a bit. I think it's 8 consecutive quarters in a row where affordability is improved. I don't know. My view, Rich, I think you and I have debated this, but just strictly from a housing perspective, when I look and I see like there's basically no new home sales in the GTA, and where I think housing starts are going, and I think where construction employment is going, and what construction employment is 8 or 9% of the labor force in Canada, I think there's a bias for more cuts.
Interesting.
But we'll see.
I'm starting to come around, to be honest.
I mean, the other, like my view, if the Bank of Canada is cutting by 50 basis points, and today they're not expected to cut at all, I would be looking at this and say, why are they cutting by 50?
Right.
And if they're cutting by 50, it means Canada has hit a severe recession. And if that's the case, there's less people working. Even if you are working, you're worried about losing your job or you're not going to get that bonus. So, I just suggest to everyone, don't believe that if you get a bank rate cut, a central bank rate cut, that first of all, it won't be 1-for-1 carried through by the commercial banks. They won't do that. That's the credit spread. But it's even more important. Why are they cutting? Do you know what I mean? That's the thing to look at. And,
I think it's a little of that K-shaped thing, though, Keith. I don't know. What I see on housing, I think, man, everybody tries to keep putting housing in this like priced income ratio. Man, nobody buys off income.
There's a lot of people who have money on the side waiting to buy either their first home or their second or third, something like that. So you are right. If prices come down enough, and that's what animal spirits are. Like, that's what you need for any market, to get true price discovery. So maybe they don't have to go down much further because there'll be a lot of money flooding in, especially the GTA area. I know a lot of people are just patiently waiting, for that moment. So maybe we're getting closer. But again, if we get a 50 basis point, if this Bank of Canada starts to change their tune, that, they might be cutting, that means there's something serious has turned in the system. And they're not saying that right now. So I'm not suggesting to be fearful of it, but it is something that's Rich's forecast that he came up with. So
I was just doing this like a mini scenario analysis. I mean, the yield curve's not suggesting that there's any changes. And by the way, the 5-year bond yield basically hasn't changed in a year. So anyway.
Well, speaking of disruptions to the system, Keith, we've been talking a lot about private credit. Seems to be more developing that space. Rich, I know you've been really monitoring what's happening in the SaaS world, software as a service. I don't know if you want to give us a quick update on what you're keeping an eye on.
Yeah, it's just more of the same. I think remember I mentioned, I think 2 or 3 weeks ago, there's sort of this like nerd fight between people who think, nah, AI is not going to replace legacy software as a service. You're not going to replace, hundreds or thousands of coders with decades of experience with a person in their basement with an AI and a database software like Excel. And what we've seen actually is one side is actually might be winning, which is that maybe those people are wrong. Maybe you will be able to replace decades of institutional and industrial coding, language, infrastructure, experience with just a very simple AI language. And so the really interesting example that happened just a couple of days ago is from IBM. So IBM is obviously, they build computers, etc. But they also, one of the things that they've done more recently is they've gotten really into sort of consulting and building enterprise software for all kinds of different companies, real estate companies, engineering firms, race car driver, racing teams, etc., space programs, whatever. And a lot of these enterprise softwares are really, really old. And I'm desperately trying to find the name of this software because I can't remember now. But basically, so really, really old. And they were programmed in the 50s, some case 60s, or 40, 50 years ago. And a lot of the people who had originally programmed this type of software basically have either died or no longer work. And I'm not even kidding. Like in some cases, literally, like the people who designed the software had literally died. And the programs and not the dialogue, but like the languages that they use and the syntax and sort of the best practices, etc., have sort of withered away. And IBM, to some degree, has been able to keep this moat around their business, e.g., keep competitors out by basically just sort of keeping the machine taking over. And what's amazing is that there's some AI products that have basically been able to go back, read and decipher sort of this legacy code, and then create a portal or new way of writing or rewriting that old code, but with like modern syntax and modern language. And so you saw companies like IBM basically lose like 15 or 14% of their stock price overnight, effectively. And so it's just fascinating. I'm sure, I know for a fact that there is a computer scientist, a software engineer who listens to the podcast. So please forgive me for absolutely butchering that. But the point is that some of the nerds A are beating nerds B right now. That's what I'm trying to say.
Nerd fight.
Fight.
Rich, you got what? Salesforce down over 40%. You've got Snowflake 30%.
Check out like HubSpot is another. So all these CRM platforms, they're getting hit. So what's really interesting as well, we've been talking about this trend now for a while, and all the private credit funds that were gating last year, they're more real estate focused. That's where they were getting in trouble. And what Rich is sharing now is that should now start to transition over to the whole, software as a service, the AI tech sector space. So we are completely expecting to see private equity, private credit funds gate coming up. Remember, this started about 2 weeks ago. So February NAVs coming out, and because they can always mark their valuations whatever they want because they're private securities. Maybe it's next month you start to see it. But what's interesting, something else we discovered. Guess who's following the Loonie hour all the time?
Carolyn Rogers.
Yeah, I think so. That's right. Bloomberg. I got a Bloomberg story this morning, and the title was "Private Credit Warning." It's kind of funny, hey, because we like to say, You know, I know Steve will joke about it. You know, Loonie are ahead of the game again, or ahead of the curve, or something. But now you're starting. My point is now Bloomberg have full scale headline articles that they're zipping out an email like to millions of people, you know, about the whole private credit sector. And it is what Rich was just describing. Like here's the comments from one of the big investors in the field. He's saying he's saying we're in the early innings of the wheels coming off the car. You know, for
Who
the
was it?
private
Name
credit.
drop him.
Bose Weinstein. I don't know who Bose is.
Good old Bose.
I don't know Bose. Um, but again, though, like Bloomberg, you know, they have fluffy stories on certain things, but not on the credit world because they're in. So think about how Bloomberg makes money. They make a lot of money from the terminals, of course, and then they also do trading as well as stuff like that. And one of the biggest users of their terminals, you know, it is credit funds, you know, in the private sector and along those lines. So for them to finally come out and, you know, start admitting, yeah, there's a challenge here. And even Jamie Dimon, you know, he's referencing the current situation today with private credit. He's saying it's very similar to what the Americans experienced back in the early part of '08. That's when Bear Stearns Bear Stearns was the first the first investment bank to have a problem with a fund there. But anyway, it's something we continue to watch. A couple of the main points, though, just for everyone to realize, is that because of the boom in the AI sector and all the lending and borrowing went back and forth, and now you're getting the decline in listed securities, like the ones that we just referenced earlier. We're likely going to see valuation changes coming up soon. Haircuts. Thank you, Rich. Or little trims off the top or the side, whatever you're into. I think Steve just grinned at that. Steve's in a good mood today. He's
Good one, Boomer.
Good. Yeah, but valuations is key. So it's not like IBM that we mentioned earlier. We know exactly what the company is worth because of the stock price. There's trade of that. Within the private credit world or private equity world, the holding they have, it's worth what the manager kind of decides what it's worth. So there is some leeway. But now the gap between the real world and then what they have in the fund, you know, that's diverged significantly. And there's also then, we're going to start to see liquidity mismatches taking place. And that just simply means if all of a sudden a lot of investors get nervous about a private fund they're holding, and then they all try to get out at the same time, and the value that they're asking to take out of the fund exceeds the liquidity amount that the fund may have. And by the way, liquidity, it could be, you know, short-term treasuries, it could be a line of credit with an investment bank or something like that. But you can have that sort of liquidity mismatch sort of gapped up, you know, very, very quickly. So you need to watch that. And the other thing with this as well, because it is the credit world, the risk may not necessarily be with banks. Because, you know, we're talking earlier about Canadian housing market and with the Bank of Canada has to cut rates because of job loss. That would hurt commercial banks because of the whole mortgage world. Private credit, a lot of it is coming from funds and private investors and not necessarily, you know, the local, commercial bank you deal with. So these are things to continue to watch. This trend is strengthening. Is maybe the housing market is maybe in the last innings for bottoming, maybe, but the whole private fund world, we could have some fireworks with that coming up here now into the spring. So yeah, that's a good update, I think, Steve, on that section.
Yeah, but Keith, that kind of like plays into like my, and again, not to go back on housing, but like that's been part of my view anyways of like why housing sales are so soft. I actually think it has a lot less to do with like tariff stuff these days. I actually think a lot of it has
dare
to
you? All of Canada's problems are related to tariffs.
I think people like certainty. And I don't think there's a lot of certainty in the world today, whether it be tariffs or I think AI too, right? I mean, if you're involved in one of these companies, which are, you know, they're massive employers, and you're seeing your stock price down 40%, I mean, and you're hearing about, you know, Claude AI is going to replace all these SaaS companies. And again, whether or not that ends up being true or completely overblown, will be interesting. But I think
So there's some guy out there watching or listening to the podcast now, taking notes, and he's like, "Who the heck is Claude? What are they keep talking about?"
Claude.
Okay, wait. Can
Claude.
I just? Do you mind if I found the blog? It's only 3 paragraphs, but I think it really rounds out everything that we've been talking about. Is that okay if I just quickly read it?
I'm gonna go to the fridge. I'll be right
Okay,
back.
fine. All right, so here we go. 95% of 95% of ATM transaction in America run on something called COBOL. COBOL is an English-like computer language designed for business use. It's amazing. So there you go. So the developers who built them retired decades ago. The knowledge left with them and also died. Finding engineers who can even read the code gets harder and harder every year. Literally, these people died. And so it's this guy who wrote this blog. His name is Sanaka Pereira. And he wrote, IBM's moat was never technology. It was the fact that nobody else could understand the code. The entire consulting empire exists because the code is too old, too tangled, and too critical to touch. Companies paid IBM billions of dollars because the alternative was catastrophic system failure. And then Anthropic, published a blog saying Claude Code can map the dependencies across thousands of lines of code, document workflows, identify mitigation risks, and translate legacy logic into modern language. Ergo, IBM's stock fell 14% in one day, the worst one-day loss since October of 2000. And those paying attention at home will remember what happened in late 2000.
What you're saying is Claude can basically read this old boomer's handwriting?
I mean, basically, that's exactly what it is. What's funny is people were worried about like all these white-collar jobs being destroyed by AI. And the irony, of course, is it's actually all the computer nerds that are being displaced by AI. Sorry, Nicholas, he's listening, but you know what I mean? It's just it's such a fascinating story that's still playing out. Who knows? In 3 weeks from now, all of this might change, but right now it's a really, really interesting story.
I am curious though, how much of this like ends up being like narrative and how much of it actually plays out in terms of, job losses and disruption. Like obviously it's gonna be massively disruption. There's lots of disruption, but I am curious to see what it actually does to these.
But that's why. Who's the guy from NVIDIA? Joseph Tan. I always forget his name.
Joseph Wang? No.
Yeah, that guy. The CEO of NVIDIA has gone on record saying it's bogus. They're not going to replace hundreds of thousands of computer software engineers with AI because of all kinds of reasons, But that's what's so fascinating.
Jason Kalkanis, is that the guy's name that runs the All In Pod?
Yeah. I think so.
Yeah, I was listening to a bit of his snippet. I think he was arguing that it's actually becoming a huge cost as you try to like scale up and build out, like basically rebuild like software using AI bots. As it actually becomes very, very expensive,
right?
That to the point where it actually becomes prohibitive, and you might actually be cheaper off doing it with humans. I don't know. So again, I'm not a software guy by any means, but it's interesting to sort of.
So now I'm frustrated. I was hoping to replace Rich. Now you're saying I got to keep Rich. I can't keep up.
Who's gonna laugh at all your stupid jokes?
Claude. One comment that you made a few minutes ago, Steve, you said, I think the effect you said there's a lot of confusion and uncertainty coming up. I think that is true. That's sort of on the ground up. But from an investment perspective, I think it's the opposite. I think it's even more like the whole private credit world. Like we've been on that for a while, and it looks like that is going to have, one of these unpleasant experiences coming up. The boom in the AI world and in the tech stocks that went with it, a lot of those have now peaked and they're coming down. And what usually happens after you have a strong euphoria at any kind of an investment market, and it comes down hard afterwards, or whatever word you want to use to name that, that's never the leader coming out on the other side. So if AI crashes now and everyone's thinking, oh, I'm going to buy these again because they're going to, get revalued again, there's going to be a new leader coming out. And we've been talking about this before. The commodity space is starting to look really juicy. I know a lot of the names in those sectors have already done well, but there's just so much money now that's going to be gushing into that sector. So think of the money that was gushing into the AI world, 6 months ago. Every day we're hearing more headline stories about it. we're actually starting to see it now in the commodity space. So you want to talk about the Canadian bank story? Because it does all tie in together here.
Well,
but my
Keith,
point is that we're not worried about where we're headed. You're always going to be concerned. But there's these big events that are happening. I think they're high probability events. So don't be afraid of it. And you just sort of accept it and make money from it as we're moving.
So, yeah, I think it's interesting, right, though, because it comes back to the conversation where, again, like this AI stuff is obviously, I mean, they're all money losers today, but the big challenge, of course, Rich, is the energy needs, right? I mean, I was joking with you guys before we started recording this, where like, last night I was getting it to build out all these spreadsheets for me and doing a lot of my tax stuff. And that basically, like, I was running so many prompts, and I have the paid version on Claude, that it was like, buddy, you're using too much. You're tapped out. Yeah, I had to subscribe to even a higher tier, because ultimately there is a cost to running all these queries, and it's energy. And so, I think they were saying in all of 2025, this is just in the United States, there were 25 projects that were in the US that were abandoned, and that was due primarily to local opposition, which is quadruple the number from 2024. And I think what you're seeing, it's all over the news now. You're seeing all of these protests. I think there was one in New Jersey in the last week where people were actively out there protesting all of these data centers that are being proposed, because at the end of the day, it's pushing up electrical bills, hydro bills for the local.
But it's going to reduce the bill you give to your accountant gives you, and your lawyer, and and all that space.
Yeah, but Keith,
but this stuff is happening. You're absolutely right, Steve. And I think the efficiency that the average person is going to experience is incredibly positive. Same with small businesses. And, there are, some folks who might have to change how they make a living.
Well, I mean, this comes down to energy requirements, certainly important in Canada.
But your point's really well made. And so one of my all-time favorite charts is basically energy consumption in the US from back in, starts in like 1960s. That's why I'm quiet. I'm trying to figure out the number. And basically for 25, I've mentioned this on the pod before, basically for 25 years, it was totally flat as a pancake. It didn't move at all. And over the last 5 years, so basically just goes going up with economic activity. In the early 90s, it basically flattened out. And for 20 years, it just stayed there. I'm trying to figure out the exact number, but anyway, so in the last 5 years, it's starting to creep up, and that's what we're seeing from all this extra computer stuff. I think it's amazing. Like it's an industrial revolution. I remember just a couple of years ago, people were talking about the end of Moore's law and how computers were bumping up against some kind of limitation of computing, and now all of a sudden that didn't happen.
Yeah, exactly. Looney hour math, right?
Yeah.
So I think it's important. It's important.
But Steve, your comment on energy, though, I think that might move into the next conversation, because it's as I mentioned, like the commodity world is going to get a lot of money gushing into it, but it's all linked together. Go ahead, Steve.
So let's go there. There's two articles that kind of stood out to me this week. There was one by Javier Blay, who's a Bloomberg opinion columnist. He's co-authored the book "The World for Sale: Money, Power, and the Traders Who Barter the Earth's Resources." He's an excellent follow on Twitter. His article in Bloomberg is titled "Net Zero is Dead: Long Live Renewable Energy," and basically he goes on to say that when the world's richest nations got together in 2022 for their biennial energy meeting, their communique mentioned net zero 13 times in 2024. The references went up to 15, and after last week's gathering, just one occurrence, and that was to underline the lack of universal support. The word count collapse illustrative of the direction of global energy policy. Net zero is effectively dead. And so we can kind of banter a little bit on that article, but I also thought there was an interesting article that was tweeted out by Secretary Chris Wright, who's the 17th United States Secretary of Energy, where he basically tweeted out an article saying, if you get, it says Europe is addicted to American energy. And he goes on to say, if you get energy wrong, almost nothing else matters. Years ago, Europeans were not paying dramatically more for the energy than Americans, but by making energy more expensive and unreliable, it's led to deindustrialization. And it's a really good article, obviously showing that the fossil fuels still count for I believe it's 4/5 of
83%.
yes, energy consumption. So, Rich, I mean, this is your wheelhouse.
Oh, baby. This is a Loonie Hour victory lap. I meant when we first started the Loonie Hour, I think in 2021, feels like many lifetimes ago, many computers ago, many apartments ago. I said that net zero was total bullshit, and pardon my French, but I was right then, and I am right now. It's never going to happen unless we go full scale nuclear power. To reference the energy minister's point, Europe has gone the opposite way by shutting down 23 gigawatts of nuclear power, which is a crime against humanity and probably the dumbest thing any government's ever done, really. But yeah, I mean, this is just the inevitability of physics. There's a lot of people who are much smarter than me who've been talking about this for years, and I'm really happy that everyone from the 6 major banks in Canada to the United States government to the Chancellor of Germany to our dear leader, Mark Carney, have basically all, in no uncertain terms, moved away from what was always a failed experiment. Meanwhile, China and India and the rest of the world continue to build coal-fired power plants en masse. And just so everybody understands, like Europe's emissions peaked in 1979, US emissions peaked in 2008, and Canada's emissions peaked in 2007. So it's not like we're not doing things about it, but the idea that we're going to go from to zero basically in any realistic time frame, again, with the insistence on not relying on nuclear power was always going to be was always a fraud, basically. So it's really fascinating. It's all sort of come full circle.
Well, Rich, I think the thing that's interesting is like there's just like competing interests, right? Which is like, okay, like if you want to get to that net zero path, like there is a trade-off, and the trade-off, of course, is like
reliability.
You're going to be shivering in the dark, and at some point, as we're seeing, of course, I think what's front and center in the world today is cost of living. Cost of living is you're seeing the social unrest today, and that energy transition, it is expensive, and so I think you're seeing governments obviously having to step back as a result.
I challenge that, though. It's not expensive. It was the insistence on doing renewables. And in France built up an entire nuclear power industry in the 1960s after the SAAS crisis, Nasser and Charles de Gaulle. And if you look at the papers that were written by the Riksdag, the German parliament at the time, they had a plan to basically expand nuclear power to infinity. And we would have been in a situation right now where energy would be cheap, abundant, and steady. But over the last 15 years, this renewable energy grift, and that's what I call it, has broken everybody's brain. Instead of doing nuclear power, we went on to things that are intermittent and reliant on a foreign adversary for the supply chain. And so I don't agree that low emissions things has to be expensive and unachievable. I just think nuclear power is obviously the only way to do it. And eventually we'll finally get there. But it is really quite amazing how we've seen the cycle from anyone who dares speak against this, this ethos is a heretic to everyone basically accepting full circle that it's never going to work.
So what's I see now is, that sort of conversation, it's now starting to weaken. So, they're no longer talking about net zero. Basically, there's no end date anymore. That happened. I know some of the political world and the US, they're even starting to drop climate from their soapboxes, what they're going on as well. The funny thing with the private sector and money, it's always going to go where it can make money, regardless if they agree or disagree with whatever the current captured moment is. So with all the major banks in the world, they were all in on the net zero world. And I believe, was it Carney that helped put together a group of global banks that were going to focus lending towards the net zero goal and objective?
Yeah, it was the Global Net Zero Banking Alliance, and the stated aim of that group was to destroy the fossil fuel
But it was
industry.
Carney, wasn't he?
Yeah, he was
appointed
the head.
of that
He was
group?
the chairman of the global. It's called GFANZ, the Glasgow Financial Alliance for Net Zero, and it was a global coalition of leading financial institutions committed to accelerating the decarbonization of the economy, which is a euphemism for starving fossil fuel companies of capital.
Absolutely. And all of a sudden, that started to fall apart. One big bank after another said, you know what, we're not doing this anymore. Meanwhile, they were making a lot of money while they were doing it.
Right.
Now what's happening, I think it was just last week or the week before, I believe the Canadian banks have actually announced that they're going to start extending credit towards the whole let's build up NATO again. So there's a lot of ironies with that. You could argue that is sort of the opposite toward net zero. Let's save the world and planet to, let's blow up the planet. But again, banks will always go, banks are very good at understanding what the political climate is, which way the wind is blowing with things. And, this pendulum that we've talked about many times before, the Overton window, another DEI, I think that's no longer as important as it used to be. All those things have now weakened significantly. But for Canadian banks to come out and say, hey, we're going to be focused on, military spending, and a lot of that is focused on commodities as well. It further, from the investment side, it just further demonstrates that that's where, the next gobs of money are going to go into. So not the AI world. The AI we're still going to get money, of course, but it's the underappreciated resource sector in the commodity world. And specifically for the Americans, I mean, they have North America, we have Mexico, and they're moving to South America as well. The investment opportunity for Canada, if they want to be a part of that group, it's incredible. It really is amazing. And once again, the credit is going to be available for people who want to go there.
Keith, what's your what else are you looking for, in the commodity space? Is there certain? Can you chime on that or no?
Yeah, one of the things that we picked up on last year, it was our expectation that crude oil itself was basing and bottoming, and that was sort of in the mid $50 range, for WTI. And then that view was further strengthened when we started to see the non-oil commodity markets start to do really well. So oil prices disconnected, or they diverge from that space. So that's a very positive opportunity when you look at it. What's also happening now, though, is that gold prices they've diverged away from the rest of the commodity world. So, again, either gold has to come back down to regular commodity prices, which have to come back down to oil, or oil has to go up and commodity has to follow gold up. We all know the gold story and people are following that. But again, there's a lot of sort of valuation reasons, fundamental reasons why that space should do very well, because it's been neglected for so long. But again, now that we're getting, the Americans with their America First policy, their when you look at their Office of Strategic Capital, and they're pouring hundreds of billions of dollars into the rare earth mineral and cover technology space, and now the Canadian banks saying, yeah, we're going to help increase NATO spending and things like that. Again, this is this enormous positive wave of energy. Get it, Rich?
Yeah.
Steve doesn't. Steve has a face. But again, this is something, if you step back and look, it's a very positive development from an investment perspective. You can see it developing. Maybe it doesn't work out, but it's been such a neglected sector now for over a decade, because, the net zero people told oil companies, oil is bad. You're not allowed to, to look for more oil, become more productive and efficient with it. And same with the rest of the, the base metal sector. So again, this could be the next big thing in the investment world. It's not always technology related, and it's just not a loved sector at all. I know Rich has looked at a lot of data with that as well.
Well, can I jump in there, Steve, quickly?
Go ahead.
Just you said the word underappreciated. And I think that one thing that Canadians just don't appreciate, okay, I can't speak apparently, is how valuable like nuclear power is to Canada's energy sector. And I've gone on and on about it. Maybe I just will do it but it's about 15% of our nation's electricity. So that means it's 15 gigawatts. Just to put that, the German number in perspective, where they shut down 23, Canada's at 14.6. But like what we need to, as Canadians, is to provide a lot of clean baseload power in order to process and refine those minerals that we have. And something Canada has is technology called CANDU reactors, Canadian Deuterium Uranium Reactor. I have no idea what any of that means, but it is basically like a world-leading technology. And so, you talked about the net zero people trying to destroy the fossil fuel industry. One of the things they also did was try to disparage and disenfranchise nuclear power industries. And so to the point where the EU basically had nuclear power as a non-clean energy source. And only a couple of months ago did France finally twist Germany's arm sufficiently that they said, okay, just kidding, nuclear power is in fact clean. And so that's those two things, Keith, that I just think of. Like the net zero was quite nefarious in their narrow focus on how they were going to solve the emissions problem. Nuclear power is one of the ways to do it, and Canada should be at the forefront of that next leg. It's just we have it, and it's, by the way, owned by taxpayers. By the way, that technology is owned by a company, and that company is a crown corporation. So the better that technology does, the better taxpayers do. Sorry.
So the deficit is fixed just like that?
No, the deficit is effed.
The other F word. Got it.
No. But genuinely, the CANDU reactor is like a cutting edge, amazing technology that was developed in the 60s and 50s. And it's incredible. Like I've been trying to get to Bruce Power in Tiverton, Ontario to go and visit that nuclear reactor.
We'll get you there, buddy. Don't worry.
I really want to go, but it's something that Canadians should genuinely be proud of. Clean, virtually unlimited energy. Anyway.
Have you guys followed the copper story too? Just on the commodity space, Keith?
Yeah, the same thing. The whole space is just, again, I know from a pricing perspective, a lot of this space have gone up significantly right now. And there's, it's not going to be a straight ride, and straight to the top. But again, the amount of money that's going to go into the entire commodity world, it's going to be enormous. And I can't give you like a specific, hey, buy it on this day, sell it on that day.
Wait, let me write that down.
But again, just to demonstrate though, Rich knows this number better than I do. But if you look at, so you're always going to see data on how institutional investors are invested across different economic sectors, or GIC sectors, they call it in the nerdy world. But the amount that's in the metals and just and commodity space, it's not the lowest point now then, I think probably 30 years, Rich. Like it's
just off the all-time low, basically.
You got to squint. Really hard to see it. So again, so what's that number? Probably 3%, maybe?
I'm looking at it right now. 3. Let's just say 3%. It was the lows was 2, and it's just at 2 and a 3/4.
And what was the highest? Maybe 6,
12.
7, 9? Okay, 12. Okay. So Loonie hour math, we can go up, a lot, from this level. And so again, the opportunity is there. And because of the way free money, capitalism, not all the commie stuff everyone loves these days, it's going to chase the best opportunity to make money. And again, the opportunity for Canada as well as the Americans and Mexico as well, it's in the commodity world. So hopefully, we'll go more in that direction, but that's where the money is going.
So this is from S&P Global. So world electricity use is expected to grow by 50% by 2040. By 2030, data centers alone could absorb 2.5 million tons of copper, up from 1.1 million tons last year in 2025. And S&P Global warns that by 2040, copper demand could exceed supply. Demand could exceed supply by 10 million tons, creating a long-term structural deficit. Which again, I mean, these are always projections that are very hard to predict. There's a really good interview, I think it was a couple of years ago, from Stan Druckenmiller, where basically he was like, he effectively said like he feels like copper was like the most obvious trade, but that getting the timing of it was going to be the most challenging part.
Yeah.
But he's like, if you look at the supply demand imbalance, like it's so obvious. It's just trying to figure out like the price action.
Yeah. The issue is like also refining it where you get it. I mean, you not only do you need like energy, so you need like, it's crazy. Like, so one of the counter arguments is that actually commodities businesses are terrible. There's loads of commodities everywhere. Canada has every single commodity that you could possibly want. The issue is that there's so much regulatory either oversight or constraint and there's not enough energy to process it. So if tomorrow, I think if Canada just said, okay, it's totally free and open, you can dig a hole in your backyard and mine whatever you want. Plus, we're going to green light 100 nuclear reactors necessary to process those minerals. Mineral processing and refining is extremely, extremely energy intensive, which is why China does it, because they don't give a crap about climate change. And they have hundreds and hundreds and hundreds of coal-fired power plants that create lots of energy very, very cheaply. But if Canada wanted to do that, build lots of nuclear power plants and basically open up Canada from mining, I think it would change my view, my perspective on how high commodity prices are going to go. But there's no chance that they're going to do that. And so all these constraints exist. And that's why I think commodity prices are going to rise.
Here's an interesting headline just came across the screen. Australia is shipping LNG, liquefied natural gas, 16,000 miles to Canada.
Oh boy.
I find that hard to believe. I feel like don't we have like just an absolute abundance?
Well, if you measure it, depending where it is in Australia, and if it's hitting the west coast, it's going to be about 16,000.
No, but like I mean, I just figured.
Oh my god, that's the dumbest joke ever. Oh.
Steve didn't find that.
What was your question? I'm sure you had
No, I was like, don't we have an abundance of LNG? I mean,
there's no business case. There's no business case for it.
Someone grok that.
There's no business case for it. I mean, okay.
Hey, on the positive side, Keith, on the positive side, there is an exclusive today in Reuters. So this is funny. This will play on the base here. Canadian Prime Minister Mark Carney was aware of oil company Southbow's plans to revive parts of the canceled Keystone XL pipeline expansion to the United States when he floated the idea to U.S. President Donald Trump in October. A federal government source familiar with the matter said on Tuesday. Southbow is the Canadian pipeline company behind the canceled Keystone XL pipeline, but is considering reviving some of the already built line in an expansion project in Alberta aimed at transporting more Canadian oil to the United States, which again Carney has proposed apparently back in October to Trump. So there you go. We shall
Context.
See.
Context. There's 430,000 kilometers of pipeline that go north-south. So sure, let's do even more. Why not? And our exports as a percentage of total to the US is actually continuing to shrink thanks to TMX.
It could increase Canada's oil exports to the US by about 12.5%. I don't know. I just find that interesting as you head into sort of these Kuzma negotiations, and we're not friends with the US anymore, and we're gonna go over here, and so yeah, I don't know. It'd be interesting. I think obviously we've talked about this. We actually have. I'll spoil it now. We have Doomberg coming back on the show next week. So that is our interview. So it'll be interesting to sort of have a discussion with Doomberg to sort of get his opinion on what is rhetoric, what is actually going to get built in Canada and the US, and those relationships. I think his insights.
You can see if I'm totally wrong about nuclear power. He might say that I'm an idiot and I don't know what I'm talking about. That's possible.
So we'll see. We'll bring on an actual expert next week. But yeah, I don't know. It's going to be interesting. There's lots happening.
Oh, by the way, everyone, today we're going to rock your world. Today is Wednesday in the Loonie hour world. We're recording a day earlier than normal. So there's a couple extra days where things could happen around the world. And specifically, I know we've been following as well the whole US-Iran potential conflict event, whatever you want to call it. Now that the Olympics are over, the SOTU, as they would call it, took place last night down in Washington. Indian Prime Minister Modi, he's visiting Israel yesterday and today, which is Wednesday. And tomorrow Thursday will be the next meeting between the Americans and the Iranians. I think they're meeting in Geneva or Zurich, I believe, to try to come up with some kind of resolution to this standoff. So my point is that by the time we speak again next week, maybe this has developed further, or maybe there's been a peace deal struck. And if there is a peace deal that's been struck, energy prices could be a lot lower. I think WTI could be down $7, $8, $9 in that range. I know, Rich, you and I earlier were looking at the COT data for WTI.
Yeah,
were you able to see that, how it looks?
What data?
COT data.
It's
COT
for
positioning.
commitment of traders. So you're able to see in every futures market. When you trade futures in the US, when you open your account, you have to specify whether you are a hedger or a speculator. So if you are, say, Exxon, for example, you are a hedger. If you are an investment fund, you're a speculator. And
I'm a speculator.
You need both. Yeah, you need both. Steve, it's only
I'm
speculation.
I'm a crypto speculator.
Yeah, that's a speculation. But you're able, though, to see on a regular basis across all commodity groups, what the speculators' positions are. Are they max net long, max net short? And they can give you a view or a glimpse of what could potentially happen next. Rich might come up with a number here for us, but
there you go.
it's likely right now the number of speculators for the oil market, for crude oil, WTI, it's probably close to it's the highest level it's been in quite some time. Maybe.
Yeah, it's been. Yeah, I mean, sorry, the one I'm trying to dig it up. Sorry, I shouldn't have done this before.
Okay, so my point is, everyone's been piling into oil over the last 2 weeks, especially because they're anticipating, something happening over with the U.S. and Iranians. If nothing happens, then that money will come out very quickly. It will.
Yeah.
If something does happen, then there's oil prices are going to just be flying off the charts. So a lot of people who are invested to benefit from that, they'll make a lot of money, from this move. So we'll see where we are a week from today, because we got everything happening at the same
Rich,
time.
I will say this: while you've been busy researching away, you haven't lagged.
Oh, good.
So thank you for those that we were joking about Rich's laptop. Alex and Taylor at Neighbourhood Holdings were kind enough. Shout out to them to give Rich a brand new fancy computer. There's been no lag. This is the best you've ever looked and sounded.
Wow, amazing. We should share the photo of me looking very stupid and sheepish when they gave me the computer as a present when I was there last week. And speaking of visits to Vancouver, we should have announced this at the beginning of the show, but we totally forgot. Everyone needs to save the date for our 2 upcoming.
You're going to announce the show and we don't even have tickets ready.
Yeah, we'll get the tickets. That's Adam. Adam will figure that out.
This is how Rich's social life works, Like it's
no, we gotta
chaos.
Just save the date. If you live in Calgary, we'll be visiting Calgary on Monday, March 23rd. And if you live in Vancouver, we'll be there on the 25th, which is a Wednesday. And if you're super duper keen and you want to come to both, sure, that would be great. We'd love that. But yeah, it'll be a Loonie Hour Investor Series.
Yeah, thanks, Rich, for announcing that without the ticket page live. You can answer all the fan emails now.
No.
Where do I buy these tickets?
I said save the date. It's like when you're getting married. You have to tell people to save the date and eventually send them the invitation.
It was like that time that Keith said, if you want to come to the event, just send me an email. And there was like 200 emails came in.
No one showed up.
You were so pissed off with that.
Everyone's
wasn't.
CCing me.
We're going to do an Eventbrite thing like normal with all the details, etc.
I just hear road trip. That's all I hear. So it's
we couldn't
it's
forget.
fun. Okay,
right.
We will have better information for you at another time soon.
Thanks. Yeah. All right. Yeah. If you have any questions, just email Keith. That's a good place to wrap it up. As always, guys, we appreciate the support. If you found any sort of value or entertainment out of this pod along the last 5 years now, shoot us a review on Spotify, Apple. Share us with at least one friend or family member. Continuing to grow, obviously, and continuing to get more and more guests. That ultimately helps us get more interesting guests. So, as always, guys, we'll see you next week.